Welcome to Update on Tax Legislation. I'm Don Johnston, partner in Tax Services Group here at Grossman, Yannick & Ford. Welcome to session 4 of 4. Actually, this is session 7 of 8. We have 2 sessions today. This is the fourth time we've done this, the fourth and final time. Welcome to our presentation, which unfortunately we cannot do live again this year for the second year, and that's okay. At least this year we've made some progress. We have everybody sitting in the same room. So I'm in the same room with both Carissa and Mary Lou, and I'm also in the room with my co-speaker, co-presenter, Miss Marne Babich. Marne is a senior manager in our tax services group. Marne, say hello to everybody as you enter your first CPE day.
Hello.
Yeah, so Marne, she'll be on screen in a couple minutes as I get through some of the presentation. Again, welcome to our show. So for the next hour, we're going to be talking tax talk, as I call it. We're going to spend an hour talking about tax reform, potential tax reform, and some possible changes that are coming down the road. We're also going to be talking about some things that are important with respect to how, what I see in my practice on a daily basis. We know that there's tax legislation coming. We were hoping by now, by the time we did this presentation, that we were going to have a tax bill passed already, which is why we actually decided to do the tax presentation in the last session, because we were hoping by now we'd have a tax bill. But unfortunately, we don't have that tax bill, and we're probably a couple weeks away from having the tax bill. Again, welcome to the program. Hopefully everybody's doing healthy, and it's been a rough couple years on the tax side. At this point, we have more questions than answers. What we do know is that tax law changes are coming. We're expecting something before the end of the year. We're not exactly sure what those changes are going to be, what's going to be included in that bill, but I'm fairly positive. I am positive that there will be a tax bill that will be passed before the end of the year. Other things we know is that right now, both the economic and the political environment are in a state of uncertainty. As we have 2 completely divisive parties in Washington, they're fighting very hard against each other, not making a whole lot of progress in some of the things that are important to me, i.e. the tax law, and some changes that are very important to my practice and my clients' overall economic health. We also know that at this point, inflation is at the highest level that we've seen in over a decade, which is concerning as we try to grow our practice and as we try to help our clients. We have to be cognizant of the fact that inflation is there, and it's expecting to continue to increase as we look forward into the future. We also know that our workforce is in a state of flux, with virtually every industry being short of employees, short of people who are willing to show up and work on a daily basis. A new phrase has been coined called the Great Resignation, which is interesting. Something we've had to deal with shortages of employees for a while now in different industries. I mean, I see a lot of my manufacturers are running two different shifts, and they would be running more than 2 shifts if they could find the people. So it's been something that didn't sneak up on us, but it's been something that's been out there for a number of years that a lot of our clients are dealing with, and it's worse now because of COVID and because of the pandemic. It's been a lot worse over the last 18 months than it's ever been. And possibly, perhaps the worst news is, just 5 days ago, our dear football team got hammered by the Bungles, which, I'm not sure how much worse it can get. We're in a state of flux with respect to taxes and the economy, and all of a sudden we're getting hammered by the Cincinnati Bungles. So hopefully it's all going to get better from here. But with all that uncertainty, what I would say is it could be a lot worse. As far as my practice is concerned and the clients I'm dealing with on the business side, there's a lot of room for optimism. From a cash flow point of view, from a taxable income point of view, what I see from my clients is, I'll call it cautious optimism. A lot of my clients have done fairly well over the last 18 months, and the ones who are not doing well, they're at least surviving. I have not had a lot of situations where clients have gone out of business. I've had a few here and there, but I have not had a significant number of clients who have gone out of business. A lot of my clients just continue to chug along. They've figured out a way to work their way through the pandemic. They figured out how to work and have people work remotely when that's possible. And a lot of my manufacturing clients never shut down. They had some delays here and there, but they never shut down, at least not, for an extended period of time. So from what I'm seeing in my practice, my clients are doing okay. As we know, there were a lot of stimulus programs out there for businesses, both the PPP, the Paycheck Protection Program, and the Employee Retention Credit were out there. And a lot of my employees, most of my clients took PPP money, and many of my clients qualify for Employee Retention Credit. So those benefits have been incredibly helpful from a cash flow point of view, and definitely helped many of my businesses. I've got clients that got $50,000 of PPP loans, and I also have clients who got $5 million of PPP loans. So, it's definitely within that range of, a couple of thousands of dollars to a couple $1 million. It's been incredibly helpful. And in some cases, some of my clients that got those PPP loans, their cash flow has been very strong. And for those companies who didn't shut down and they continue to operate, in a lot of cases, that PPP money just ended up going right to the bottom line and being additional cash flow. And I have several clients that are in a situation where their bank debt, their outstanding borrowings with their bank are as low as they've ever been, which is kind of interesting that they've made it through the pandemic so far without having any serious cash flow problems. I know a lot of my banker contacts aren't overly happy because a lot of the debt has been paid down, but that's kind of the way it is. As far as my practice is concerned, in our tax group here at GYF, we continue to be pretty busy. We have a lot of consulting projects and things that we've been working on over the last 18 months, a lot of special projects relating to both the pandemic and non-pandemic things. And in addition to that, there's a lot of M&A activity going on right now with respect to middle market clients. I would say between 4 and 8 of my clients will probably be sold between now and the end of the year. And that's a lot. That's a lot for us. I mean, generally we have a handful, but there seems to be more activity right now. A lot of it is because of the uncertainty in the tax law. With the uncertainty in the tax law, there were a lot of companies that are out there decided they were going to sell before the end of the year, mainly because they saw huge tax increases coming, or they thought they were seeing huge tax increases coming. We all thought there were going to be huge tax increases coming before the end of the year. So we'll talk a little bit about that. As I talk about some of the provisions that are out there right now. Talking strictly from a tax point of view, it's been very, very interesting over the last 3 years. As a tax professional, the last 3 busy seasons have been very, very, very unusual. Three seasons ago, 2019, we were dealing with the Tax Cuts and Jobs Act, which was President Trump's tax package, which completely changed the tax landscape for a lot of our middle market clients. Significant changes and additions, including things like Section 199A and some other things that just caused a lot more work on the tax side, on the compliance side, to get returns done. So 2019 was somewhat of a different tax season because we had to implement all of the changes from the Tax Cuts and Jobs Act. And then 2020 busy season, we had to deal with the pandemic and extended deadline to July 15th. So that was interesting. We had to deal with that during the pandemic. And then 2021 busy season, we had to deal with another extension, which was to May 15th from April 15th. So we've had three very different busy seasons, different than any other busy season I've ever had during my career. So it's kind of been interesting. So what do we expect in 2022? So at this point, we're thinking that it's going to be somewhat of a normal busy season. We're not expecting any changes or any extensions. At least that's what we see at this point. As far as tax law change, we're anticipating that there will be something done before the end of the year, which I will talk about. So the good news, based upon what we think is going to happen with respect to tax law changes, we're thinking the majority of our clients are going to be in a much better situation, a much better position than we expected them to be in when we were doing planning back in May, June, and July of this year. When we were doing planning back then, we were expecting significant tax law changes and significant tax rate increases, and the changes that were coming, we were anticipating we're going to have a very negative effect on our business clients. But again, those were the original proposals, and the proposals we're seeing now, the revised, cut down proposals, are not even close to being where they were in May, June, and July. And some of that we think has something to do with both the Virginia and the New Jersey governor elections, which happened about 2 weeks ago. In some ways, it feels like those two elections completely changed the Democratic landscape as far as how they're trying to get tax packages through. Some of the more aggressive things that they were thinking about before are no longer in the most recent package that we've seen. So it's definitely interesting. In some ways, there's a lot of uncertainty out there on the tax side. So let me move over and talk about some of the topics to be covered that we're going to cover today. I'm going to do a little current tax update, talk about the provisions or the proposal that's out there right now and some of the things that have changed already in 2021. Then Marne will talk about the pandemic-related matters and areas for consideration. She will also talk about other federal tax things that we see that are important, areas of importance. Then I'll talk a little bit about state income tax, sales tax exposure, specifically referring to Wayfair. And then if we have time at the end, we'll throw out some tax planning thoughts and strategies. Okay, so let me start here just with the key 2021 tax legislation, things that have passed and things that are potentially going to pass. So first, we've got the American Rescue Plan. Let me see if my little highlighter here works. There we go. So we've got the American Rescue Plan, which was enacted in March of 2021. The majority of the tax changes there had to deal with family issues, things like recovery rebates. It was in that package that the third stimulus check was approved. That stimulus check for married filing jointly was $2,800. And then there was another $1,400 per dependent. So some people received quite a bit of money in the March-April timeframe as a result of the American Rescue Plan and the recovery rebates under that third round of stimulus. Also included in the ARP, if you will, additional changes to child tax credit, and those child tax credits were effective in 2021. So there were some advance payments that have been received by people at this point, and it is something that's going to have to be reconciled when you do your tax return. If you did get some of that money, if you didn't get that money and you qualified for it, you'll be able to fix it when you do your 2021 tax returns. But a lot of people actually are already receiving those advance payments from the IRS. In addition, there was also a child and dependent care credit where they actually extended and expanded the amount of child and dependent care benefits for people who are working and have to pay child care. Those changes were fairly generous because what they saw was a lot of people having problems because of COVID. A lot of people having problems finding somebody to babysit or watch their kids. So they substantially expanded the child dependent care credit program. Then the last thing I'm going to mention, the unemployment benefits. They decided that unemployment benefits for tax year 2020 are not considered taxable income, which was a change from the old law. And unfortunately, that was actually not passed until I think it was March. Yeah, it was March when they passed that. So anybody who filed a return before March had to either amend a return or the IRS was supposed to send back a refund for any tax that was paid on unemployment benefits. Also included in that ARP, the American Rescue Plan, there was extension of the employee retention credit. They extended it to both the third and the fourth quarter of 2021, although the BBB plan, which I'll talk a little bit about, actually reversed that. One of the things that didn't make it into the ARP, which was something that was very popular, that was discussed by President Biden both during his campaigning and early on, was the possibility of getting rid of some student loan forgiveness. At that point, they were talking about getting rid of $10,000 of student loan debt for thousands and thousands of students who have a lot of student loan debt. That never made it into the ARP, and that's not something that we've really heard a whole lot about over the last 6 months. So that particular benefit, if you will, seems to have died on the vine, as we haven't heard a whole lot about it over the last several months. So let's move on and talk a little bit about the what's going to happen, state of the pending 2021 tax legislation. I will tell you that I can almost guarantee you that there will be a bill that will be passed before year end. I cannot imagine a scenario where there's not going to be something that's going to be passed. The reason for that is, one, since the Democrats control Congress, both the House and the Senate, I think they would look really bad if they can't get a tax bill passed, because part of the campaign and part of the promise and what we've been hearing over the last year is the fact that there are going to be significant tax law changes, and to not be able to pass that in 2021, I think would be a big problem for the party. So I do anticipate that something will happen between now and the end of the year. I will say that where I anticipate this thing's going to land is going to be very different from where it started. The original proposals going back both during the campaign and in May, June, and July, when some of the plans were set up, if you will, the original proposals were very aggressive with substantial tax increases. I'm not expecting that that's going to happen in this bill that's going to be passed before year end. And then the other thing is compromises are needed to be made. So with the party barely having a majority here, if you know that there are 50 Democratic senators, 50 Republican senators, so the Democratic Party only has the ability to pass the law by having the vice president be the tying vote here. They cannot afford to have one Democrat decide that they don't like the package. So we've heard a lot about West Virginia Senator Manchin and his demands, and basically him putting his foot down and say, hey, I don't like how this affects my people in West Virginia, so I will not vote for A, B, and C. You need to change that. So Senator Manchin has a significant effect on what's going to be passed. And it's very interesting how he pretty much has put his foot down on certain things, saying that he will not vote for things. And if he doesn't vote yes on these, it can't be passed. Very, very interesting. So let me talk a little bit about a couple things. So these are provisions. These were things that were being talked about in May, June, and July. Proposals, if you will. These were initially talked about, but as you're going to see, and when I talk a little bit more in detail about the BBB, these things did not make it in. So there was supposed to be a corporate tax rate increase from 21 to 28, top individual rate 37, 39%. The big one here, capital gains rate. The discussion was that capital gains for wealthy taxpayers was going to be increased from 20% to 39.6% for wealthy taxpayers. That is a big deal. I will tell you, I have several clients that, because of that particular provision, because of the possibility that the capital gains rates was going to be close to doubled, that they decided they were going to sell their businesses before year end. At least 2 to 3 of my clients, they're very close to being sold, and we're going through the due diligence process now. They're very close to being sold. They are being sold this year because of this particular proposal. Now, the way we see it now, it's probably not going to happen. But if you think about a 20% rate difference in a capital gain, that's a big deal. If you have $1 million gain and all of a sudden your tax goes from $200,000 to $400,000, that is why some of my clients decided they are selling. Also included in some of these provisions was the elimination of step-up and basis of death. I'm not going to spend any time talking about that. Changes to the carried interest rules, very important for private equity clients. I've spent a lot of time doing research over the last couple months on carried interest issues. And that was in the original provision. Also included in the original provisions was increase in net investment income tax. This is a big deal for our clients, especially S corporations, and I'll talk a little bit about that as I move on. Okay, so let's talk a little bit about some of the provisions that have been passed. We've heard of the Infrastructure Investment and Jobs Act. This was passed on November 19th. I will say that there were very minor tax implications of this bill. This is the one that was passed right before Thanksgiving. The most significant tax provision here that affects my clients and businesses that I work with is the elimination of the employee retention credit. They eliminated that for the fourth quarter of 2021. And I think Marnie's going to talk a little bit about that when she talks about ERC, so I won't go into any detail on this in particular. Okay, so let me talk a little bit about the Build Back Better Act. This is the tax bill that was passed and made it through the House on November 19th. $1.7 trillion bill, and this has a lot of tax changes in it. So I'm going to talk a little bit about some of those changes. I will say that this thing is in the Senate right now, so there's still a lot of work before this thing gets passed. Who knows where it's going to end up? I've read some things that say that there will be some changes, but they will not be significant changes. So let's talk a little bit about the BBB, as I will refer to it. But before we do that, let's hit our first poll question. So the question is, what are your predictions on whether or not the Build Back Better Act will pass before the end of December? So just alert to anybody who's not paying attention who wants the CPE, you kind of need to answer the question. So I'm giving you alert to answer the question. I will look at what we have here. So Mary Lou, how long is this going to go? It'll be on home?
It should be up.
Okay, so it's up, and I can just go, right?
Mm-hmm.
Okay. So let me go back. I want to see what the results are. So less than 50%. Wow, I'm surprised. At this point, it says less than 50% of the people think this thing's going to be passed before year end. Interesting. I'm a little surprised by that. I would probably say in my mind, I think there's a 98% chance that this is going to pass before the end of the year. I really do, just because I think they have to work something out. Because if they don't work something out, I think they're potentially losing a chance to make a significant tax law change here. So I'd be very surprised if this thing doesn't get passed. I'll actually go and predict that this thing's going to be passed into law, signed into law on December 23rd. I'll say plus or minus 1 day, and I'll say December 23rd. The reason I say December 23rd is, one, I think they want to get it done before Christmas because I think they want to go home for Christmas. And two, I don't think they want to take it all the way to the 24th in case something blows up on the 24th. I think they need the additional day. So I'm predicting 12/23 with respect to the BBB in some form being passed. So let me talk a little bit about what is in the BBB, the Build Back Better Act. And again, these are still just provisions, but some of the more important things that I see, and I'll talk a little bit about the individual piece, and then I'll talk a little bit about the business piece, and then back to the individual piece. So the child tax credit, the American Rescue Plan made some changes with respect to the child tax credit, but those changes were only effective for tax year 2021. The BBB provides a 1-year extension through 2022 for the child tax credit, which increases the child tax credit and the amount of money you can get back for the child tax credit. Makes the extension of refundability permanent. And like I mentioned a little bit earlier, these child tax credits, some of the advanced credits are already happening. So a lot of people, many people are already getting credits in advance. But I will say, if you're getting those credits in advance and your taxable income is higher than anticipated, and you shouldn't be getting that, you may need that. You have to take that into account when you complete your tax return when you complete it in 2022. And these child tax credits are phased out. So if your taxable income, married filing joint taxable income's over 150, you don't qualify for those credits. The second thing included in the BBB that I think is very important is the SALT deduction cap. Okay, so several years ago with the Tax Cuts and Jobs Act, President Trump, in his bill, limited the state tax deduction as an itemized deduction to $10,000. While we know that the Democratic Party and their constituents did not like that because it eliminated the state tax deduction for a lot of very high tax states. So under the BBB, the limitation would now be $80,000. Okay, so that's what's in the BBB right now. I think it's very important to note that this is effective in tax year 2021, which means that for anybody out there who would benefit with respect to itemized deductions because of the $80,000, you need to be thinking about that between now and the end of the year. You don't want to wait until 2022 to make your estimated tax payments for your fourth quarter for your state purposes if you can get a tax deduction for that in 2021. This is also important for a lot of my clients who have transactions. So if you think about $80,000 in state taxes is a lot of money. You know, you pretty much need to be making about $1 million a year to be paying $80,000 of state and local tax, depending upon what state you're in. So that limit is very, very high. It's kind of interesting because Senator Sanders, Bernie Sanders, came out right after this provision came out in the BBB, and he basically doesn't like it. He thinks that and I'm trying to quote what he said, he thinks it's ridiculous that in the current economic situation we're in with the deficit that we have, that we're giving rich people tax deductions of up to $80,000. And in some way, I completely understand what he's saying because, I mean, you've got to be making a lot of money to be able to deduct $80,000 on your Schedule A itemized deductions. So it's kind of interesting that the limit is that high. I would not be surprised if this was changed, or if that limit is not changed, I would not be surprised if there's some type of ceiling on this, whereas if you make over $400,000 a year, for example, you're not able to deduct the entire $80,000. But like I said, this is effective in 2021 if it's passed, so we do need to be paying attention to it because it is important. And it does provide a pretty big tax deduction. You don't want to miss an $80,000 tax deduction or even a $20,000 tax deduction if you can take that in 2021. I also will note that, interestingly enough, this is a revenue raiser, which when you think about it, makes absolutely no sense because they're giving you additional itemized deduction difference between $10,000 and $80,000. But the way they backed into this being a revenue raiser, and I call it funny math with a capital F, funny math, because by extending this through 2021, when initially the $10,000 was going to expire at the end of 2025, they kind of made up some numbers. It's almost like A plus B equals B plus C plus D plus E. I mean, it's just completely crazy how they backed into this being a revenue raiser. It doesn't make. I understand. At the end of the day, I understand it, but like I said, it's kind of funny math in my opinion. The next thing I talk about, this is very important, the net investment income tax. This was in the original proposals back in May, June, July, when some of the original proposals came out, the net investment income tax. So basically, you know, the Congress thinks that there's a loophole out there for certain pass-through companies that have pass-through income and they're not paying either self-employment tax or payroll tax on that income. So a perfect example is, let's assume I'm an S corporation shareholder. I own 100% of the S corporation, and I have pass-through income of $1 million, and I also have W-2 compensation of $300,000. So on the $300,000, I pay payroll taxes on that $300,000, but the $1 million of flow-through income is not subject to net investment income tax because I'm an active participant, and also I'm not paying payroll taxes. So they look at this as a loophole because a lot of people are getting away with not paying taxes on this income. This would be a big hit, you know, for anybody who has an S corporation and who's not paying tax on this. It's a 3.8% tax hit, so it is a big deal and very important for a lot of my clients. I'll put a little check mark there because this is a pretty big deal for a lot of my clients. Excess business losses. The BBB changes the rules with respect to excess business losses. As a result of the pandemic, for tax years 18, 19, and 20, they did away with this. This was something that popped up under the Tax Cuts and Jobs Act, and basically what it limits is the amount of losses you're allowed to take in any particular year, any business losses you're allowed to take to offset other non-business taxable income. So the limit is $524,000 in 2021. This could be a big deal, not as big of a deal as some of the other things that I've already talked about. Section 1202, small business stock. This is in the provision. I'm not going to go into this. This is a very limited situation. I just want to make sure that I'm following my time cut off here. So I'm going to pass on 1202. I'll pass on that a little bit. I want to talk about some of the business changes. Some of the business changes include a 15% minimum tax. This is pretty much an alternative minimum tax. They're not calling it an AMT, but it is basically an alternative minimum tax. This applies to companies that have over $1 billion in profits. So, I don't have to worry about that with any of my clients. I don't have clients that big. But this is a very big hit to businesses that are most of the time obviously publicly traded that have that kind of profits. But there's an alternative minimum tax of 15%, and it is a big deal. There's also potentially a 1% surcharge on corporate stock buybacks. Again, publicly traded stock. And there's quite a bit in the BBB related to foreign operations or companies that are foreign owned, which I'm not going to go into any detail at this point. Back to individuals in the BBB, an additional 5% surcharge is being proposed for anytime your adjusted gross income is over $10 million. And there's additional 3% when your adjusted gross income exceeds $25 million. So, if you're over $25 million, you're talking about another 8% tax hit, 8% tax surcharge. Okay. You know what? Let me go back here. Let's go back here. One of the other things also is this does take into account trusts and estates also, which is a big deal because those limits are pretty small. Starts at $200,000 and gets up to 8% when you're at $500,000. So it is a big deal, which leads to our second poll question. If the high earner surtax is enacted at 5% on trust, modified adjusted gross income over $200,000, would you reconsider the types of assets held in trust? The answers are yes, no, unsure, or what is a trust? See, I'm going to move on. It'll stay up for them, right? I'm just going to move on. So let me finalize on the Build Back Better Act and the tax provisions and what we've seen. Nominal changes. I'll call them nominal changes with the BBB as compared to what we were looking at in May, June, and July. First off, interestingly enough, no change to the individual ordinary income tax rates. I mean, we've been hearing about the tax rates being increased from 37 to 39.6% for close to 2 years. No change to the capital gains rates. That is incredibly important. Like I said, I've had many clients decide to sell their businesses in 2021 because they were expecting a 20% increase in the tax rate with respect to capital gains in 2021 and 2022. No change in estate tax exemption. The estate tax exemption is over $11.7 million roughly. We thought that was going to fall down to about $5 million. There are no changes with respect to the estate tax exemption in the BBB. No changes to the carried interest rules. Again, that's important for my private equity clients. So it's something that I see quite often. So let me hand it off to Marne. He's going to talk about some pandemic-related issues and things of importance. And
Okay. Good afternoon. The next two topics on the pandemic-related matters, PPP and ERC, we're going to stick pretty high level on these two. Mike and Dan did a nice presentation a couple weeks ago that went more in depth on the topics. So high level is on the agenda for this afternoon. PPP was launched in April 2020. It was really designed to help businesses keep employees employed during the pandemic. There were two rounds, PPP1 and PPP2. PPP2 ended May 31st, 2021. And most companies have already applied for forgiveness under PPP2 or are currently in the process of doing so. Full forgiveness should be the goal, and that will be achievable if the loan proceeds were spent on eligible expenses. Just a reminder, some of the eligible expenses are payroll, mortgage interest, rent, and a new bucket of other covered expenses, and those needed to have been paid during the 24-week cover period. And also just a reminder within that, in order to be fully forgiven, at least 60% of the loan has to have been used for payroll purposes, and headcount needed to be maintained or retained. If a taxpayer received more than $2 million, the SBA will audit that loan. And if they received under $2 million, it was deemed that they received that amount in good faith and that it was necessary to support ongoing operations. Originally, when PPP1 and PPP2 started, there was a loan necessity questionnaire. The SBA, thank goodness, did away with that in July. So those are no longer applicable for PPP loans. Then the federal and state tax consequences of the PPP loan. So for federal tax purposes, the proceeds from the loan are not included in taxable income, and the expenses paid with the loan proceeds are deductible. So it's a best of both worlds for federal income tax purposes. For states, unfortunately, the states had to make it a little bit more difficult, where most, followed federal, some did not. Luckily for those of us that are here in PA, they did follow federal. So the loan proceeds aren't taxable and the expenses paid with them are deductible. And for your flow-through entities, that income, so to speak, is reflected on the return as in the tax-exempt income bucket, which does result in a basis increase for the partnerships and the shareholder partners and shareholder stockholders. And recently, the IRS issued Rev Proc 2021-48 that talked about the timing of when that income becomes tax-exempt income. And they did allow for a lot of flexibility within that. They gave 3 options. So the first option was as eligible expenses are paid or incurred. The second option was when an application for PPP loan forgiveness is filed. And then the final option was when PPP loan forgiveness is granted. So those are some of the highlights on the PPP loans. Moving over to employee retention credits. So as Dawn mentioned in a previous slide, this did end, after the third quarter of 2021. Still opportunities to go back and amend for some credits, even for closed periods or, previous periods. So it is still worth going through the highlights. It is a refundable payroll tax credit. It's available for both profit and not-for-profit, but not every business is eligible. So there's 2 critical tests for eligibility: partial or total government-ordered shutdown, or a decline in gross receipts. 2 categories of eligible employer, small or large, and that's actually defined based on your head count in 2019. So the decline in gross receipts needs to be significant, and that is defined differently for 2020 and 2021. So for 2020, that's defined as more than 50%, and for 2021, more than 20%. And when you're calculating that percentage, you're actually comparing the gross receipts to the same quarters in 2019. Again, different rules for 2020 and 2021, because they can't make this easy on us, and they want me to get tongue-tied with all of these dates. So for 2020, the max per employee, the wages that could be used in the credit was $10,000, and the credit was 50%. So you could get $5,000 per employee. And then in 2021, it was still the $10,000 per employee, but that became per employee per quarter, and it increased from 50% to 70%. So you could get, for your 3 quarters in 2021, a $21,000 credit compared to your $5,000 credit in 2020. So those were favorable changes to the program. Unfortunately, with ERC, it's a little bit different that PPP, PPP did not have a negative effect on taxable income. ERC will result in an increase in taxable income, because to the extent that you took, a wage deduction for wages that ERC credit was paid on, you will have to reduce those, resulting in a taxable income increase. And the timing of that is tied to when the wages were paid. So if you decide after listening to this presentation that you do qualify for ERC in 2020 and you file those amended 941Xs, you will need to go back and amend your 2021 tax return, even if that cash isn't received until 2021. So we do have a federal income pickup or an expense reduction for those ERC credits. Again, just a friendly reminder that between PPP and ERC, you can utilize both programs, but you can't use the same wages for both programs. You have to have enough wages to cover your at least 60% of your PPP loan and then excess into ERC. For the 941Xs, we are seeing about 8 months for processing of a 941X. So if you did decide today to file that, it would be about 8 months until cash was received in hand. We are seeing that if the credit was claimed on a timely filed 941, that those refunds are coming a little quicker. And we've actually seen with several clients that the second quarter cash is received before the first quarter cash when the second quarter is filed on timely filed returns. I have a couple of little statistics here that in 2020 of 941s, timely filed 941s, only 1% contained the ERC, and in 2021, only 3% contained ERC. So for 2021, that's 97% of taxpayers that are not claiming the ERC. So opportunity still available for those ERCs and filing those amended 941s. So it looks like we have another polling question here. So if you applied for ERC on amended 941X, how long did it take to receive your refund? Greater than 2 months, between 2 and 4 months, still waiting, haven't filed yet, or unsure. So since we're running a little bit short on time, I'm going to go ahead and move through that polling question. Looks like we have a large percent here, maybe 21% that are still waiting on refunds. Assuming the 52% didn't file refund claims yet. Not surprised at all. I know it can be very frustrating because a lot of those ERC claims can be significant dollars that businesses need, but not surprised by that result. Okay, a couple other pandemic-related matters. So family and sick leave credits. So these actually first appeared in the Family's First Coronavirus Response Act. They're 100% refundable tax credit for sick leave and expanded family and medical leave. They're available to businesses and tax-exempt orgs that employ fewer than 500 employees. Credit for the sick leave, it's 100% for up to 80 hours of sick leave paid. And for the family and medical leave, it's 10 weeks paid. Both the sick leave and the family and medical leave have to be related to COVID-19 illnesses. And those were for wages April 1, 2020 to March 31st, 2021. And then after that March 31st date, the American Rescue Plan came in, same provision with the paid and sick leave for up to 80 hours of paid leave. And it did increase the family and medical leave from 10 weeks to 12 weeks. And that's for wages April 1, 2021 to September 30, 2021. And when you're calculating those credits, you can also include health, your qualified health plan expenses, and your share of Medicare tax on those wages. So just some highlights on those two credits. I think, there's always a lot of talk about PPP and ERC, and those ones don't get, talked about as much, but those are definitely out there. And if you paid those wages for COVID-19 reasons, make sure you're looking into those credits. Another pandemic-related change was business meals. So normally business meals are 50% deductible, and they changed the rules to allow 100% deduction in 2021 and 2022 for meals that purchased in a restaurant. So it has to be purchased in a restaurant. As we all know, restaurants were very hard hit by COVID. So this was a way to help drive businesses into the restaurants. No changes to the entertainment expenses as part of this. So if you're doing sporting events or tickets to a show, those will still have the 100% non-deductibility. So some other federal tax matters. The IRS, right now, probably over the past 18 months, trying to get an IRS agent on the phone to resolve issues has been extremely difficult. And I checked on the IRS website, and they said, they had a posting in November of 2021 that they still have 5.9 million unprocessed individual returns. So they are still working on clearing their COVID background. So as frustrating it is for taxpayers, and it's frustrating it is for practitioners, just some patience as we're all working to resolve the backlog of issues with the IRS. The Biden administration does feel that there's some opportunities for efficiencies within the IRS. They would like to invest about $80 billion into the IRS. And what they're hoping from that investment is that, compliance will increase, and they will be able to get additional dollars from some of the wealthier Americans and large corporations. A couple other technical areas. So I know Don previously mentioned Section 199A. Just wanted to throw that on there. That was created by TICJA, so effective for years after 12/31/2017. The deduction there, if it's qualified business income, is 20%. So if you have, an S corp that has $5 million of taxable income, 20% of that's $1 million deduction. So just something, to keep in mind if you haven't been utilizing Section 199A, you want to add that into your planning to make sure that you're working with wages and some of the other property limitations to make sure that you can get a full benefit of the 199A. Elimination of certain tax benefits. Dawn did previously mention the excess business loss, so I'll kind of skip over that one. That one did come into play as TICJA, was changed by the CARES Act, as Dawn mentioned. And then just the item to keep in mind there is that for 2021, that limitation is now back in play. So, if you have an S corp and one shareholder, $1 million loss that's flowing through to an individual return, they're only going to be able to take a benefit of about $500,000 on the current year return, and the rest of that is going to carry forward to next year. So something to factor in when you're doing planning and projections here at almost, I guess, the fourth quarter. The NOL rules, this is another fun game we played. TICJA came in, changed the NOL rules. The CARES Act came in, changed them again. Now the CARES Act temporary provisions are expired, and we're back to the TICJA rules. So just a reminder for 2021 that taxable income can only be offset 80% by an NOL. So you may have $3 million of NOLs going into 2021, and current year 2021 income is only projecting at $1 million. Don't think that you don't have to make a fourth quarter payment or an extension payment because you're going to be able to offset fully that $1 million. You'll only be able to offset $800,000, and you will still have a liability of $200,000 that you'll need to pay tax on. Shareholder comp, again, just a friendly reminder here that the IRS would like to see reasonable comp. Filing a tax return with very high distributions and very low shareholder wages can be a red flag on the IRS, as they might feel that you're trying to avoid some payroll taxes. So just trying to consider, hey, if the person that was providing the service wasn't the owner, what would we pay them? And kind of using that as a benchmark to set your reasonable comp. Somewhat kind of ties into the point below. So for the 199A we talked about above, shareholder wages don't count for a 199A benefit. So while you want to make sure they're reasonable, you don't want to make sure they're not excessive, because that can bring down your 199A benefit. So it looks like we're rolling into another polling question here. And it says the Section 199A deduction is available to all pass-through businesses. So we'll go ahead and give you a chance to answer that question. All right, well, we'll see how that updates. I will move on to the next slide, because right now it's saying 100% unsure. So it might just not be updating timely. So it looks like next we're moving on to, we're going to circle back to Don, and he's going to give an update on some state income and sales tax related matters.
Yeah, so I just want to make a couple comments on some of the things that Marne talked about. Section 199A, initially we thought that was going to be adjusted under the Biden tax plan. It's certainly something that was being talked about in May, June, and July, but it didn't make it into the BBB, which is good news for our clients that qualify under Section 199A. Hopefully it doesn't make it into the BBB, because there's a very important benefit. A couple other things. With respect to the employee retention credit, it's kind of interesting. When the employee retention credit came out, they basically passed the law and the rules and basically said, these companies qualify for the employee retention credit. They did not attempt, or at least we haven't seen if they attempted to quantify how much that was going to cost with respect to the deficit. With the PPP, we knew how much we were growing the deficit by the PPP funds, because there was a certain amount of funds that they were setting aside for PPP. Under the ERC, there was no limit. So I don't know if they ever calculated or anticipated how much they were going to have to give businesses with respect to the ERC. We've seen ERC credits as much as $1 million a quarter for some of our bigger clients that have a lot of employees. Like Marne said, that calculation is based upon up to $7,000 per employee per quarter. So if you qualified for the ERC in the first, second, and third quarter of 2021, I mean, you could be talking about significant money. So it's one of those things that we're going to be asking every one of our clients to provide us with the sales information for 2019, 20, and 2021, because we want to make sure that if somebody qualifies for the ERC, that we are getting that money. Initially, back in 2020, when PPP and ERC came out, you could not double dip. You couldn't use both ERC and also use PPP. But the rules were changed in December of 2020, where you could use both ERC and PPP. You just couldn't use the same payroll to benefit both PPP and ERC. One last comment. I do want to answer a question. Somebody asked a question. It was Lori. So if you're paying attention, Lori asked a question with respect to net investment income tax, and the change under the BBB, whether that would be effective in 2021 or 2022. Our understanding is that would not change until 2022. Most of the provisions under the BBB would not be effective until 2022. The only thing that I know for sure of that's an exception to that is Section 1202 and changes to Section 1202. Okay, so let me move on. State income tax and sales tax. The reason I want to mention this is just because it is important. This goes back to something we talked about in prior CPE sessions. That would be the Wayfair case, which is state of South Dakota versus Wayfair. And basically, this comes down to something that's called economic nexus. This was a Supreme Court case that was settled, I believe, in June of 2018. And basically, with the Supreme Court case, it allows states to open up and challenge and make businesses file both possibly sales tax returns and possibly income tax returns in their states, even if they do not have a presence in their state. So, for example, let's assume I'm a Pennsylvania manufacturer. I ship $5 million of my product, my widgets. I ship $5 million of widgets to South Dakota. Even though I never set foot in South Dakota, because of the Wayfair ruling, it is possible that South Dakota can pull me in and require me to collect sales tax because I have economic nexus in their state. Prior to that Supreme Court case, that was not permitted. After that Supreme Court case, it is now permitted. So soon after Wayfair was settled, every state that has a sales tax changed their rules and their statutes to now allow them, at least in some way, to require companies that don't have a presence in their state. It requires them to, in certain cases, collect sales tax. So it's a big deal. You don't want to get caught not complying with a particular state's sales tax rules if you have a presence in that state, and it can be as simple as an economic nexus. The other thing to mention here is, the question comes up now. We all have remote workers that are working all over the country, right? I mean, it would not be unusual for one of my professionals to spend 3 months in Florida because they can work remotely. I mean, we have a remote policy. It's not 100% remote, but we do have a remote policy. So the question is, if somebody's working for an extended period of time in a particular state, do you now have remote nexus? Do you now have nexus in that state, which now requires you to file a tax return in that state, possibly an income tax return, and possibly you are now required to file payroll tax returns in that particular state. It also asks the question, do you have workers' comp issues in that state? What if you have an employee who's working remotely in Florida and they're on their way they're doing something work-related and they have a car crash or they fall down and break their leg? Are you covered for workers' comp in a particular state in that particular situation? So it's important under the new remote worker policies that we all have. It's important for you to be following the rules with respect and paying attention to where people are actually working. So let's move on. We have about 5 more minutes, and we're going to move on to what I believe is the final poll question. How has the number of remote workers employed during 2021 at your business changed as compared to pre-2020 levels? Increased by more than 10%, increased by more than 25%, no significant change, decreased, or unsure. I'll let you answer that question. I want to move on. You can see right now it's increased by more than 25%, by more than 50%. So that's not surprising. So just a couple tax planning considerations. Obviously, looking into the future, we've got some very uncertain times that we're dealing with right now. A lot of uncertainty as we close in on year end. We're going to be paying a lot of attention to what comes out of Washington. Like I said, I anticipate a tax bill to be changed to come out the week of 12/20. So we'll be paying attention to that. So look and pay attention to the GYF website, as we'll be posting something as soon as it comes out. And we do think it's unlikely there'll be any significant tax legislation in 2022, which is why I think it's increasingly important for a tax bill to come out in 2021, because it's no easier in 2022 to get it passed as it will be in 2021. And like Marnie suggested here, IRS service limitations. We've got people on the phone with the IRS consistently trying to get through the IRS to try to deal with problems. With our many clients, we pretty much need to talk to the IRS almost on a daily basis to try to get something resolved, something fixed. Okay, we'll run through some planning strategies, just have a couple minutes, so I'll run through these pretty quickly. Number one, hire a professional to provide assistance. If you're an individual and you're preparing your own income tax return, if you are not absolutely sure that your return is correct, you should at least every third year take your return to a professional, and take your return to a professional when it's not busy season, maybe in November, December timeframe, and just ask a professional, a CPA, to review your return to make sure you're not missing something that's very big. It would not be unusual to have somebody review your return and come up with 3 or 4 comments with respect to your tax return. Plan in advance. Finding a qualified professional is getting harder. A perfect example, let's assume I'm trying to sell my business and I need an environmental study done. I'm not going to be able to find an environmental study or somebody to do an environmental study just by picking up the phone and calling, because there are so many transactions going on right now. So many of those professionals doing those types of reports are just not able to do it at this point. I'm going to blow through these real quick because I know I only have another minute left. Okay, I'm a little too far there. The next 2 things, talking about college costs. One, start early, start putting the money away early. Start planning for those college costs because they do add up. I know because I have 2 kids in college right now, so it's very important to start early. And pay attention to the state where your kid is going to college. And understand the American Opportunity Tax Credit, Lifetime Learning Credit. Those are important. I'm going to skip the EITC. Marty, I'm just going to cover these last 5. I was going to have you cover them, but we're out of time. Be aware of pending legislation. Pay attention to our website, because we are constantly trying to be on top of pending legislation. Make sure you understand the 0% capital gains rate. Be especially cognizant if you have any foreign investments or any cryptocurrency issues, because the penalties when you're not reporting those are very, very steep. Be aware of estate planning matters, which means doing more than just setting up an estate plan. Make sure your documents are current. And timing on everything is important, whether it's a 2021 issue, a 2022 issue. And planning is important, like I talked about with the SALT tax. Making sure that you're doing things in the right period is important. And Chris, I'll let you take over.